In this video, I'm going to tell you what all of these are, how they work, and why they're important. So with that, let's get straight into today's video. The S&P 500 is short for Standard & Poor's 500. Essentially, it's a stock market index that comprises of 500 of the largest publicly traded companies in America. It represents a diverse cross-section of the US economy and is a leading indicator of the country's economic performance and health. All right, so how does it work? The S&P 500 is a market cap weighted index, which basically means the weight of each of the companies in the index is determined by its market cap. Now, a lot of you are probably wondering, what is a market cap? Market cap is basically the number of shares that a company offers multiplied by the price of each share. So for example, Apple offers tons of shares and their share price is very high. So you're going to get a very large market cap. Whereas another company, a smaller company, might offer a limited number of shares and they might be trading for a lower price. You multiply those two together, you get a smaller market cap. As such, larger companies like Apple will have a larger influence on the index movements. Why is it important? The S&P is a benchmark for the performance of the US stock market. Also, a lot of investors and fund managers use it to compare their own returns. Additionally, the index serves as a reference for the overall health and direction of the US economy. Next up, we've got the Dow, or the Dow Jones Industrial Average. So the Dow Jones Industrial Average, commonly known as the Dow, is one of the oldest, if not the oldest, stock indices in the world. It comprises 30 large publicly traded companies representing various sectors of the US economy. How does it work? Unlike the S&P 500, the Dow is a price-weighted index rather than a market cap-weighted index. This means that the movement of the index is determined by the absolute price changes of the stocks that it's composed of. Why is it important? The Dow is considered an indicator of the overall sentiment of the US stock market and economy. A lot of people view it as the pulse of the US stock market given its longevity and high profile status. Alright, so the NASDAQ is an acronym for the National Association of Securities Dealers Automated Quotations, and it's basically an electronic marketplace for trading to occur in the US. Most of the trading that happens on the NASDAQ is for technology focused and growth oriented stocks. As such, it lists numerous tech giants like Amazon, Apple, and Microsoft. So how does it work? So the NASDAQ operates as a dealer's market where buyers and sellers come online and they buy and sell shares in these growth and tech companies. It's known for its electronic trading platform, which enables fast and efficient trading between buyers and sellers. Why is it important? The NASDAQ is closely monitored and seen as a barometer for the performance of the tech sector. So tech and growth oriented stocks, you want to see how they're doing? Just focus on seeing how the NASDAQ is performing. All right, so those three, NASDAQ, S&P 500 and the Dow Jones, are all US based stock indices. The next one, the FTSE 100, is a UK based index representing 100 of the largest stocks that are trading on the London Stock Exchange. How does it work? Similar to the S&P 500, all the companies in the FTSE 100 are market cap weighted. So the index is a market cap weighted index. The higher or the larger the market cap, the more influence it will have on the index. Lastly, why is it important? So the FTSE 100 is a crucial indicator of how the performance of the UK stock market is doing. It serves as a benchmark for the UK's economy, and it also provides insights into the country's largest publicly traded organizations. Next up, we've got gold. Everyone knows what gold is, but where or how does it fit into the world of financial markets? What we all know is gold is a precious metal that's valued for its rarity, its beauty, and its resistance to corrosion. Throughout history, gold has been used as a store of value and it's been used as a form of currency. How does it work? We all know gold is primarily mined and it's refined into gold bars or jewelry. It can be traded on commodity exchanges, and it can also be bought as an investment or a hedging instrument. When we say hedging, we're talking about protecting yourself in your financial markets investments. Why is gold important? Gold has been a store of value for centuries. Given it's a hedge for inflation, it's often seen as a safe haven asset during times of recession or economic uncertainty. All right, oil, this is a big one. West Texas Intermediate, or WTI, is a form of crude oil that's used as a benchmark in oil pricing. How does it work? WTI is extracted and refined into various petroleum focused products like gasoline, diesel, jet fuel. The futures contract essentially lets buyers and sellers lock in a price for the oil at a future date. Why is it important? Oil is a critical global commodity and its fluctuations can have a huge impact on the economies of various nations all over the world. WTI acts as a reference for oil prices and it has a massive influence on energy prices also all over the world. Last one, the 10-year Treasury. So if you have heard of the 10-year Treasury and you've ever wondered what on earth is that, but you've been too scared to ask people, I'm going to go through it in simple terms right now. So the 10-year Treasury is a debt security, kind of like a loan, issued by the US Department of Treasury, and it has a maturity of 10 years. That's why it's called the 10-year Treasury. Essentially, it is considered a benchmark for long-term interest rates and government bond yields. Whenever you hear bond yields, just think return on bonds. So if you buy a bond, you're going to get interest. The interest is the return. So how does it work? So the US government sells 10-year treasuries in order to finance its operations. So they're going to sell these 10-year loans and they're going to give interest to people who buy them. The money that they get, they are going to use that to finance the government's operations, and as a result, they're going to pay people interest who have given them that money. Investors purchase these treasuries and they receive interest semi-annually until the maturity date, when they are paid back the face value. The 10-year treasury is closely monitored by investors and economists because it reflects market sentiment for the economy in the future. It's also used as a benchmark to determine the interest rates on loans, mortgages, and other financial products. If you found this informative, or if you've learned something from this video, let me know in the comments below, and let me know what else you want to learn in terms of financial markets or finances in the comments, and I'll hopefully make a video for you in the future. With that, I'll see you in the next one. Peace.